Welcome to another episode of the Hidden Money Podcast. We are starting today a real estate series. Now, you've heard us talk about real estate in the past, but really we are going to section this off into bite-sized chunks because when you start investing into real estate, it can get overwhelming. You don't know how to structure things. I don't know interest rates, tax law, all of this kind of plays differently. And so what we're going to do is just kind of take it podcast by podcast, step by step, how to get into real estate. We're going to have some guests on, hopefully, to talk about specific segments of real estate. But we're going to focus today on the entity creation, just how do I start investing and
Very
why?
basics.
And why do I want to get into real estate for tax purposes? Because from a tax standpoint, there's major reasons to get in there, and we always preach, don't just buy real estate to save taxes. That's kind of foolish. You want to find a good property that's cash flowing, that's going to grow in value over time, but if we can find that property that kind of hits that sweet spot, there's ways to get tax benefit on it as well.
Yes, that's the hidden money in real estate. We all know real estate. We see people make money on real estate, right? You make money on the appreciation of the real estate. You make money on rents or operating the real estate. But there's hidden money, big hidden money in real estate, mainly in the form of depreciation. And I assume most of our listeners know what depreciation is. Just for the few that don't, depreciation is something the government makes you do. Let's say if I'm a taxi cab driver, I go buy a $10,000 taxi cab. Because that cab has a useful life of more than 1 year, the IRS says I can't deduct all $10,000. I have to depreciate it over its useful life. So oversimplifying it here, but I could depreciate $2,000 per year. Thing is, with that taxi cab, when you take any car off the lot, brand new car, used car, it depreciates in value the second you drive it off of the lot. Depreciation in real estate is magical. It's powerful because when you buy that property, unless you're buying it in some very rare, horrible place like maybe Detroit, Michigan or something, it's going to go up in value. So depreciation is magical in real estate because you're getting to take tax deductions for depreciation on an asset that's appreciating up in value. That is magical, and it helps you leverage and snowball your investments and your growth and depreciation. We'll get more into the tax aspects of it here in a minute, but there's a lot of different ways to invest in real estate. You can invest in a syndication. You can invest in your own single family property. You can invest in a short-term rental, long-term rentals, duplexes, multifamily, big multifamily. But before you invest in any real estate, you got to cover your assets.
Yes. So we are not licensed attorneys. We are not allowed to practice law. We're just not. We are CPAs. We've been in rooms with attorneys and we know what they're going to say typically, but everyone's legal situation and financial situation is so different. So take what we say in the next few minutes with a grain of salt. I would consult your own attorney if you don't have one.
Always consult your own attorney.
Yes, for sure. So when you're structuring real estate, and we can get into the lending aspect, because some lenders, if you've never invested in real estate, you can't just go get an LLC and be like, hey, I'm going to put this property in an LLC. Some lenders may frown on that just because there's no history with them. There's no history of a business there or an LLC, so you might have to buy it personally. But generally, what we recommend is our clients put in their real estate into an LLC. Now, this could become an administrative headache if you have 10 rental properties, and there's creative ways to even structure that. But let's just keep it simple. You buy one rental property, typically you want that one rental property in its own LLC, because if someone slips and falls because of a faulty handrail, or they are dumb and they jump off the roof into the pool and they're trying to do tricks, or, and then they could sue for any number of reasons. Well, the roof wasn't the shingles. I would have landed that if, they could sue you for anything.
And you don't have to be in the wrong to have a lawsuit actually attached to you. To have a jury, do you guys remember the McDonald's coffee at the drive-thru? Someone got McDonald's coffee at the McDonald's drive-thru, spilt it on their leg in the drive-thru. They spilt the coffee and it was, I think it was like $30 million lawsuit. So you always need to be covering your assets, cover your liability. So again, we're not attorneys, but the basics are, If you have a business operating in a limited liability company or a corporation or a partnership, there's a bunch of different avenues, and Kevin's going to explain why we like LLCs to start with. But if you have a business operating in it, if that entity gets sued, as long as you follow all the rules of maintaining your corporate veil of protection, the lawsuit can only take stuff out of that LLC. They can't go take your own home. They can't take your other investments. That's the basics. Kevin.
Yeah, hence the name limited liability company. You are limited in your liability. So if your rental property is named in a lawsuit because of that faulty handrail, they're not going to sue you individually. They're going to name the LLC. Now, the other attorney more than likely is going to do discovery and say, hey, is this LLC really separate? Maybe you're not operating a different bank account. So just because you have an LLC, you still need to kind of play by the rules here, because a good attorney is going to try to pierce that LLC and go to your personal assets, because that might be where your wealth is.
Commingling is one of the biggest ones. And again, seriously, if you're going to do this, don't just take our advice. Go find an attorney, ask them, how do I maintain my corporate veil of protection? But one of the biggest I see with our new clients that are brand new in real estate, they created the LLC, but they're collecting the rent checks in their personal bank account.
It's like, what's the point of an LLC now?
They're using the LLC's bank accounts to buy their own groceries. That is called commingling. You do that and you get sued, the plaintiff's attorney is going to have a heyday with you.
Yeah, yeah. So from the onset, and I want you to kind of speak to the lending side, just because it's all well and good to get an LLC, and a lot of times what happens is you might be listening and you might already have 4 or 5 rental properties that you own personally. So we kind of need to do some restructuring and getting with an attorney to get those properties, if risk is a thing. If you're out there, the LLC, I'll say this, a common misconception with LLCs is I need one to deduct. Like, hey, I'm going to start a business. Should I start an LLC to deduct things?
There are CPAs out there on their podcast that say you have to have an LLC to get taxed.
Where is that in the IRC? It's not. So you do not have to have an official entity structure to deduct things. It's just not true. So the LLC is a straight liability protector. And so we always want to get our properties in there, but you may already have 4 or 5 rental properties. There's ways to get that and get your train on the right tracks, but it's going to take some due diligence. And let's say I'm just buying my first rental property though, and I'm looking to get into the investment game, whether short-term or long-term, and I want to structure this from a short-term or from a liability standpoint. I want to structure it. Can I go get an LLC out of the gate and then go close inside of my LLC?
You absolutely can, but you got to be talking with a lender that knows how to work with LLCs or commercial lending, business lending, not just going out and buying your own personal home lending. Those mortgage brokers that just do personal and primary homes, they're going to have problems with the LLC. Generally, when you go out and buy your own home, if it's under $1 million or whatever the jumbo loan value is these days, you can put 10% down. If you're buying a operating real estate property, a rent, let's say a single family home, you're not going to be able to get that 10% down. Generally, there's some lenders out there still offer it, but generally you're going to tell them, I'm buying a property to rent it, to run it as a business. They're going to require you to usually put at least 20% down, sometimes 25% down, but you tell them from the beginning your LLC, the name of your LLC, the EIN of your LLC, and you can close in that LLC and be the lender. Here's the deal though. That liability protection is all great if someone sues you. If it's your first rental property, or even your first few rental properties, the lender is going to make you sign a personal guarantee. So you're going to still have to guarantee the debt on that property, but the property itself is inside, and the mortgage is inside that LLC, which your attorney will be very thankful for if you ever get sued.
Yeah. And this is actually, we in the past, we kind of disagreed on debt, right? Like using debt to get assets, or you want to be debt free. And we kind of, when we first started working together, we kind of butted heads on debt. And you're like, well, it's not.
Even though we were both Dave Ramsey fans.
Yeah.
And I'm still a Dave Ramsey fan. And I called into a show once and just outside of college, I'm debt free. I believe in debt free for the most part.
Yeah.
But
this debt's different.
Very different.
So this is why this debt is a little different. And when you go to a lender, some people are like, oh, and Dave preaches this. And I'm not saying it's bad financial advice. I'm just saying it's not probably applicable to most people to buy rental properties down in cash. Because the whole point of buying real estate is you're going to buy an appreciating asset, and that debt is going to be tied to that asset. So your asset is going up in value, and hopefully your debt is being paid down by tenants. So your debt is decreasing. But let's say this property's not performing and you're covering the debt personally, you could dump the asset. And more than likely, if you did your due diligence and bought in the right spot, that asset sale is going to cover the debt. So it's secured debt. The interest is tax deductible. And the beautiful part, as you mentioned it earlier, leveraging. If you buy $1 million property, whether you put 20% down, you're out $200,000, or you buy that the Dave Ramsey way, 100 or put $1 million down, let's say, you're going to get the same tax deduction either way. Tax deductions aren't relied on your cash in this instance. That's why typically as a taxpayer, you're going to be cash basis. And all that means is every time money comes out of my pocket, I'm going to get a tax deduction for it. This is an interesting part in where you finance an asset that is $1 million. We're going to get deduction on the $1 million, even though your cash is only out 200,000. And then we can accelerate and plan and get so much of that depreciation off $1 million asset.
Magical depreciation on an appreciating
Yes,
asset.
and that's why debt in this instance not scary.
And that's not the only benefit. So let's take the same example. You go buy a house and you put $1 million down. 5 years later, you sell it for 1.5 million. If you put $1 million down and pay cash, you made 50% on your money. That 500,000, you made 50%. Now go the other way. Let's say you put $200,000 down. 5 years later, you sell it for 1.5 million. You turn 200,000 into 700,000. So you got a 250% gain on the same asset instead of a 50% gain. That's where the leverage in real estate makes sense. And again, like Kevin said, it's not like you're going out and borrowing a bunch of money on your credit card at high interest to go gamble or go on vacation. You're borrowing money, and I preach. Not everyone does this, and there are good arguments against this, but I strongly believe you should always get a fixed rate mortgage. Interest rates go up, interest rates go down. For all of the 2010 through 18, no one got fixed rate because it was cheaper mortgage if you got on. But they were hating life in 2022 and having to dump assets because the interest rates go up. Get a fixed rate mortgage. Make sure it's something that your operations, your tenants can service that debt. Make sure you have a rainy day fund for the vacancies that are gonna happen in real estate. But this is debt that, in generally, like Kevin said, worst comes to worst, you lose your job, some horrible thing happens in your life, you need to liquidate, the debt's gonna be paid off by the asset.
Yeah.
It's not
And
sunk.
I don't know if you know Dave Ramsey's story, but essentially he leveraged real estate all in his younger years. And so he had millions of dollars of debt. So there is risk and don't hear us and say there's no risk in doing this.
Don't over leverage.
Don't over leverage. But what happened was, I guess, his bank that held all the notes, they sold the notes to a different bank. And the bank's like, who's this young guy that owes us $10 million? They start calling the notes. And so they were foreclosing on his properties. And so he went bankrupt because of it. So there is risk doing this.
But that was a different kind of debt too. If it's a true mortgage instrument, there's a contract between you and the lender. And even if the lender sells your note to someone else, that contract carries through. So it can't be, you got to be careful. And again, you get an attorney to read those documents, read that lending agreement. They can't, if you get a good one, they can't force you to sell just because they don't like you. Yeah. There's got to be other reasons. Yeah. You got to miss payments.
Mm-hmm. So the debt is one, when you're buying any real estate at the very onset, that's going to be a conversation you need to have and some analytics you need to run. What's my interest rate? We recommend a fixed rate, just so the market isn't just killing you. The variable rates, don't balloon anything. I mean, just get a standard fixed rate, tried and true mortgage payment. Your mortgage payment's going to be predictable so that you can cash flow and manage this rental to make sure your rental's right. Like if you have a variable rate and you're meeting your mortgage payment 1 month and then the rate goes up, you can't raise your rents if it's a long-term rental. So that's why the fixed rate is so good, is it's predictable and you can cash flow on that a little easier.
That's part of your underwriting. And believe it or not, even though Kevin, generally I'm the aggressive one, Kevin's the conservative one. When I bought a rental property 2 years ago, interest rates were high, super high. I couldn't get, the best interest rate I got was somewhere between 7 and 7.5%. And the house, I know it's a good house and I know it'll make money in the long run, a lot of money, but I ended up putting 45% down because I wanted to be guaranteed that even in slow times, even if I had 2 months of vacancy every year, I'd be able to service the debt. And I closed at, so when you put 45% down, they lower the interest rate, but I closed at 7%, which used to be a terrible rate. That was the best rate I could get. At that rate, and with that money down, I guarantee as long as I can rent that place 10 out of 12 months a year, the rent is going to pay the debt. So do your underwriting, do your calculation. I don't like putting 45% down. But I wanted that property, and it was a good property and a dang good investment. And I put 45% down.
Yeah, that's very smart. And, I've even seen strategies to where fixed rates aren't terribly lower than your variable rate. And let's say your variable rate's 9% and fixed rates at the time are like 7 or 8. You could get in a variable rate, and then when the fixed rates go down to 5 or 6, refinance.
Yep.
That's a risky move because your variable rate could even go up further. So that's, unless you're really attuned to the market conditions of real estate, I don't recommend getting into variable to play the hope like, well, I don't want a 7% fix. I think it's going to go back down to 3 or 5. Well, it could, but so the only way to do that is, you can always refinance also from a fixed rate.
That's why we preach fixed rates from the get-go. As you learn more about the business, then you can maybe start playing in that area, is in an educated way, not a risky way.
Right. So we talked about the LLC structuring.
Why an LLC? So some people, we've seen clients come in, they have a corporation or an S corporation. Why is an LLC important?
They're flexible. They're easy and cheap, and they work. It's tried and true in court. This thing has passed under the iron, like under the fire, right? It passes if you run it right. So there are ways to utilize corporations, even your retirement account. You can invest in real estate in your retirement account, which I would love to get into as well. But from an LLC standpoint, you could self-form it. You could do it yourself with the Secretary of State of where you're at. Just be careful of what state you're in. And then really it's easy to operate. The filing fees every year, or the upkeep, the paperwork to keep your LLC in business, not that hard. In Texas, it's a franchise return.
And the IRS gives you the option of how to tax that LLC.
It's flexible.
If you're the only owner, or you happen to live in a community property state and you and your spouse are the only owners, you can treat it as a disregarded entity, meaning you don't have to file another tax return, meaning your tax preparer doesn't get paid that extra fee for filing a whole nother tax return for that one property. You got to consider your operating costs, your holding costs of a property when you're doing your underwriting, because it gets expensive to file a tax return every year. So an LLC can be a disregarded entity, or you can turn it into a partnership, but then you have to file another tax return. As a LLC, whether it's a partnership or a disregarded entity, it's what we consider a flow-through entity in tax. That means you don't file a separate return, it just shows up on your tax return on a schedule of your personal 1040. So that's simple. And if you're getting tax benefits from it, you get it. Here's where we had this client. This happens 2 or 3 times a year. It drives us
more often than not. I know exactly where you're going.
We get a new client comes in, they got all this property and it's in an S corporation. And we get all these reasons why. Usually it's the CPA told them to do it. I hate that. Yep. Don't get an S corporation. They've got debt on the properties. They should be able to take a bunch of that depreciation from those properties and reduce their current tax bill. But they can't because it's in an S corp. If it would have been in an LLC, LLC taxed as an LLC, as a disregarded entity or partnership, no problem. Mm-hmm. But they can't do it in an S-Corp. When you do it in a C-Corp, you don't get any of the tax attributes. And then if you're making money in that C-Corp and want to take some of the money out, you're paying 2 taxes, double taxation. So LLC, baby.
The only time I would ever recommend any sort of real estate inside of a corporation is if you're if you're a business owner and you self-rent your own building. If you have a commercial property and you own it, you might want to put that in the, more than likely or not, you wouldn't commingle your business and your property. But from a tax standpoint, it would not be nice to have it all in one. But really,
there's a few other areas. Like I would say in my 25 years of doing this, I've probably recommended 15 or 20 times for people to put their real estate in S-Corp. If they're paying all cash, if there's no debt. There's a few different reasons that might make good sense, but 90, if not 99, 98% of the time, LLC. And here's the deal. If an LLC turns out to be, you're one of those 2% where you shouldn't have had an LLC, you can elect to have your LLC taxed as a S-Corp. as a partnership, as a C-Corp, you can always make that election. And in a lot of cases, you can make that election retroactively after you've talked with a good tax strategist. So LLCs are number one.
LLCs, yes. And then if you start bringing in partners, you could look at limited partnerships, LPs, but generally even LLCs are just tried and true. If you're kind of a syndicator raising money, that is a
Whole
different
different
beast,
breed.
which we're going to get into. We're going to do a syndicator series. So if you are looking to raise money to buy big multifamily or hotels, then LLCs aren't your tried, they're not going to be your default. They could be, but there depends on the goals of the partnership. So that will be a different series. But we're speaking in this one just for your individual investors who's wanting to branch out. More than likely you're in an LLC. More than likely you want that fixed rate mortgage, fixed rate debt, seeing cash flow, underwrites, and how much am I going to put down? So how much am I going to receive in rents? What's my other overhead? You know, because you're going to have utilities, maybe not utilities. Depends on your deal with your tenant, but you know, lawn care, repairs, kind of build that in there so that you're making money. And really what I tell my clients and my viewpoint, and you could disagree with me here, if my rental property's net neutral cash flow, I'm cool. Someone's paying the debt. There's a benefit that you're getting. So even if you're making nothing on that property cash flow take home, someone's paying down the debt on your appreciating asset. I'm okay with that deal. Where else is someone going to pay down a debt of an asset that I own?
I'd rather have cash flow. I'd rather have positive cash flow, but absolutely, as long as it's not as long as I'm not having to write a check out of my W-2 every month for that debt
Yeah.
or for the operations of the LLC, it is a good investment.
Yeah, because the real estate, you know, depending on the area, like we're in North Texas. North Texas, our real estate's been going up like 8 to 15%.
More,
Everyone's
yeah.
moving here. Where else am I going to get 8 to 15%, if not more, on my money? Real estate's a really good move here. So that's why you make sure you're with the right team and real estate agent if you're going to be buying, because you want to be in a good market.
Yes. So also, there's one other time an LLC makes sense too, in my opinion. And again, consult with your attorney. But here's what my attorneys told me. Sometimes you're buying into a syndication or a partnership of like a multifamily housing unit or a storage unit. And you're just, as a passive investor, you're buying into it. You absolutely can do it as an individual. My attorney has convinced me, who happens to be your attorney too, that you're better off putting it in an LLC for a multitude of liability protection reasons. Even if I'm trying to get the tax benefits from that investment in that partnership on my personal return, I can do that through an LLC. So that's the entity creation. Let's talk
One more thing real quick before we move on. If you also want to be looking at the future, like if your goal is to, hey, I want one rental property a year, or if I want 2 a year and I want to do this for 10 years. So you know in 10 years from now you're going to have 10 or 20 rental properties. You got to plan for that. That might look like a little different. That's why getting with your own attorney and tax advisor is so important, because your goals may be way different.
Very different.
You might want a holding company that has a series LLC, which we didn't even talk about. But you could want a holding company, an operating company, and you might want each property in its own LLC. And then you got to talk about insurance. We haven't talked about insurance. You're going to have a homeowner's policy on these things, but an umbrella
and a
coverage,
renter's policy.
yeah, or renter's policy, you might want an umbrella policy on top.
I should have said landlord's policy, but yes.
And let's say you have a pool. You're renting, that's a huge liability. If you have a pool in any kind of vacation rental or long-term rental, you might want additional coverage there. So every situation is different, but be thinking about these things.
Before we end this episode, let's talk about the tax benefits of real estate. Whether you're buying a single family house, a multifamily, whether you're buying a strip mall, whether you're buying a storage unit, any kind of real estate, as we mentioned in the beginning, has a beautiful, beautiful tax attribute called depreciation. And again, this is a tax deduction, a paper deduction, not a real deduction, a paper deduction on your tax return that can reduce your taxable income while your asset is appreciating in value. You can get that, and it's a beautiful thing. Now, there are rules. Like if you're like me and Kevin, we have a full W-2 job and we're not in real estate, we can't qualify as real estate professionals. So any depreciation I get from a real estate professional type property can't offset my active income or his active income, but it sure as heck can offset my other passive income, no doubt. there's other loophole. We're going to have a whole episode on short-term rentals. We've talked about them before. We'll keep talking about them because it is the one surefire way someone like Kevin or I or you who have a full-time job and can't qualify as a real estate professional can take that awesome depreciation and offset your W-2 income or your business income. That's a beautiful thing. And then it's an active deduction. You don't have to just offset it against passive. Depreciation is great. Let's say my in-laws, and this happened before they moved down here, lived up in Coeur d'Alene, Idaho, which is a beautiful place. I want to travel up there once a year. I do it anyways already. I also think it's a good hot real estate market. If I buy a real estate rental or a single family rental up there to own, to operate, to keep, the IRS allows you to go check on your business assets once in a while, and you can deduct that at cost, or at least part of that cost going out there. There's a lot of tax benefits in real estate. We say, don't ever let your tax tail wag your business dog. Don't do that. Buy good real estate to make money. But dang it, it is a nice kicker. I mean, when you really think about it, if the income, especially in a short-term rental where you're offsetting your W-2 income, if the deduction you get from that thing can give you money back in your pocket, the IRS is basically subsidizing your investment in real estate.
Yeah.
How can you not want to do that?
The market's just craving right now real estate tax experts, and that's what I think we really are. We do a lot more than real estate, but I think we've really have a cornerstone of our practice that is real estate. Just because there's such a need in the market that we've seen from our competitors where we're fixing their mess. And I'm not tired of fixing the mess. I'm tired of seeing shoddy work out there that's
because our
hurting
clients
people.
pay for it.
And they're paying more
yes.
than they would with us to get it right the first time. So we actually started a new product this year. It's for exactly real estate investors. It is pinpointed directly. We're going to help you choose the right structure, entity type. We didn't talk about, community property states, husband and wife going into business together. There's so many ways to do this. You have children.
So many different deductions.
So many deductions. And if you have children, there's ways to legally pay your kids out of the business and get a tax deduction out of your tax bracket and them not paying a lick of tax because they don't have another job. We haven't gone through, and we are next episode, right after this episode, we're going to get into short-term real estate. But our real estate package covers everything from the start. Then we're going to cover short-term real estate, all the tax benefits related to that. Then long-term real estate, if you're into long-term real estate, then exits. We're going to talk about how to exit a rental property or income-generating property wisely, because all of this is good, but when you sell an appreciated asset, you're more likely going to have depreciation, recapture, and capital gain. How do we mitigate that? So this is exactly what our real estate plan attacks, is from everything from A to Z. And we would love to just educate you and get you on the right path towards your real estate adventure, just because we can see the fruit in our clients. I can see the cash flow. I can see the immediate tax deductions that they're getting off this strategy. And so we would love to talk with you. Go to revotaxpayer.com and you can schedule a free strategy session with Mike or I. I would love to tell you more if this real estate plan applies to you. But there's tremendous benefit out there.
So much benefit. And real estate in itself is a great investment. But when you wrap in the tax benefits, and for us, we talk about them every day. We know them well. But honestly, most CPAs don't. We keep seeing people underserved. If you can wrap in and leverage those tax benefits, you're getting a multiplier. And if you're doing this for a period of time, for 10 or 15 years investing in real estate, and you're adding another 10 or 15% to your annual ROI because of taxes, suddenly in 10 or 15 years, you have 3, 4, 5 times the amount of a nest egg than you would if you weren't utilizing tax. So please check us out, hiddenmoney.com or revotaxpayer.com. Ask for a consultation. We'll give you a free one.